Hi everyone, today we are so glad to have Mr. Phil Gronniger, the Client Portfolio Manager at Janus Henderson Investors, to attend our Know the Manager section today. Philip has extensive experience of fixed income investment and large cap growth portfolio. He joined Janus in August 2010 as Senior Product Manager for Fixed Income Strategies, and he now represents the fundamental fixed income and asset allocation strategies of Janus Henderson to clients and prospective clients. So hi Philip, thank you for coming today again. So as 2018 is really a very volatile year, so the first question I would like to ask is related to risk. What geopolitical events are you watching for, and how might that affect US and global market?
Thank you for having me here today. And as we look at 2019, there are many geopolitical risks on the horizon that could increase or enhance or heighten the volatility during the calendar year. One of those is the potential increase in trade war rhetoric between the US and China. We do think that it's likely there will be some sort of resolution, so it will not be overly detrimental to markets, but that will be an important geopolitical risk to watch for. Another large geopolitical risk is the unknown with Brexit. We recently saw a large defeat by Theresa May, and fortunately for her, she made it through the confidence vote. However, we think that will weigh on markets for quite some time, including after we come to the ultimate Brexit deadline date. It's likely there are some other geopolitical risks out there that will continue to keep volatility elevated during 2019.
So my second question is about interest rate. US interest rate have been creeping up for a while now. So in your view, what's the Fed plan for 2019? Will it be dovish again, and how might it affect the US and global economy?
We think that the Fed will raise interest rates probably just one time in 2019. As we look at the tail end of 2018, volatility increased dramatically. Heading into the fourth quarter, market expectations were for 4 more interest rate hikes. We had the December rate hike, but by the end of the calendar year, market expectations were beginning to forecast rate cuts in the future. We think the Fed has a history of raising rates too much, and perhaps this time they will err on the side of caution and tilt a bit more dovish with only 1 more rate hike. However, that being said, we know that Powell's desire would be to get the front end of the yield curve higher ahead of the next potential slowdown. If the economic fundamentals or statistics justify, we know the Fed will likely try to do more than 1 rate hike during the calendar year. We don't, however, think that the whole yield curve will be moving very much higher. So while the front end would go up with 1 more rate hike, we think the long end of the curve will stay relatively put, thus further flattening with an increased potential for an inversion in the latter part of the year if we don't see continued, or if we don't see more inflationary pressures.
Okay, I see. So the third question related to fixed income, as I know you are an expert on this side. So can you let us know what's your view in high yield credits and investment grade bonds? And do you see high gearing is a concern?
With respect to corporate credit, we've meaningfully reduced our exposure to investment grade credit. During last calendar year, we saw credit spreads widening out steadily on investment grade after hitting their tightest levels early in the year that they had seen since third quarter of 2007. Investment grade companies have been re-leveraging balance sheets since about the middle of 2014, and they're doing that to reward shareholders through dividend increases, share buybacks, and M&A activity. The pace of M&A activity, we think, will remain heightened as companies try to borrow more and more to buy growth as global growth decelerates a little bit. And we don't think we're being compensated properly to lend money on the investment grade credit space, particularly on the long end of that. We do have some exposure to investment grade, but we're underweight the asset class, and we've also shifted our exposure more towards the front end of the curve within investment grade. With respect to high yield, we still have a very constructive view on that asset class. Quite different than investment grade, many of the management teams that we meet with in the high yield space have been continuing to tell our analysts they're trying to strengthen and improve their balance sheets to be upgraded from a single B to a double B, or from a double B to a triple B. So we see improving fundamentals there. Additionally, while the supply of investment grade has increased quite a bit with the borrowing to reward shareholders or for M&A, high yield issuance and high yield supply has been declining the last couple of years. So from a technical standpoint, we find that asset class relatively attractive. Valuations, though, are to be considered and cautioned against, though, because high yield spreads are relatively tight too. And in fact, last year, in early 2018, and again towards the end of the year before the volatility increased, high yield spreads had touched their tightest levels that we had seen since third quarter of 2007 as well.
Last but not least, what's your investment strategy for 2019?
In 2019, for an asset allocation strategy and also for fixed income specifically, we have been reducing equity exposure a little bit heading into this year in an asset allocation strategy that we have that has a maximum weighting of 65% equity. We're currently sitting at about 57% equity. That reduction was rather gradual throughout 2018. Within the fixed income sleeve of that asset allocation strategy, we've significantly increased the defensive posture there with an increase in US Treasuries, a reduction in investment grade credit, and adding some duration to the portfolio. We still have a constructive view on the equity side though, so still remain overweight equities, but realize that volatility in our view will be heightened throughout the year and it will not be an easy path to positive total return for investors.
Right, got it. So thank you again coming to our section today.
Thank you for having me.
Thank you.